You can be perfectly right about the market's direction, but still lose money if you choose the wrong spread type based on volatility. Let's assume you are bullish on a stock. You have two primary vertical spread choices: buy a debit call spread or sell a credit put spread. They both profit if the stock goes up, but they behave completely differently under the hood. The fundamental difference lies in who pays whom. With a debit spread, you pay cash up front to enter the trade. With a credit spread, the market pays you cash up front, and you keep it if the option expires worthless. Think of the debit spread as buying a lottery ticket with better odds. You want a big move to pay off your cost. The credit spread is like being the insurance company. You want things to stay quiet so you can keep the premium. This creates an inverse relationship between probability of profit, POP, and potential ROI. Credit spreads generally offer higher win rates, but lower returns on capital. Debit spreads offer lower win rates, but higher explosive potential. But the single most important factor in choosing between them isn't your directional view. It is implied volatility, or IV. This is the price tag of the option premiums. When IV is high, options are expensive. You want to be a seller, credit spread. When IV is low, options are cheap. You want to be a buyer, debit spread. Ignoring this is the most common rookie mistake. Imagine trying to sell flood insurance during a drought. No one pays high premiums. That is selling credit spreads and low IV. You receive very little credit for taking on the same amount of with risk. Conversely, buying a debit spread in a high IV environment is like buying a house during a bubble. Even if the stock moves in your direction, a drop in volatility, Vega crush, can eat up your profits. Next, let's look at time decay, or Theta. Time is the enemy of the debit spread. Every day that passes without the stock moving eats away at your value. For credit spreads, Theta is your best friend. You profit simply by waiting. If the stock stays perfectly flat, the debit spread loses money, but the credit spread reaches max profit. This creates wiggle room. A credit spread usually places the strike prices away from the current price, out of the money. The stock can move slightly against you, and you still win. To calculate your break-even points, the math is reversed. For a bull put credit spread, you have a buffer below the strike. For a bull call debit spread, the stock must rise above your cost basis. Now let's discuss the psychological toll. Credit spreads carry steamroller risk. You win small amounts often, but one bad loss can wipe out weeks of gains if you don't manage risk. Debit spreads are psychologically easier to manage for beginners because your max risk is defined immediately upon entry. You can never lose more than you paid, and you don't have assignment risk until expiration. However, the death by 1,000 cuts is the risk for debit buyers. Losing 50% of your premium over and over again because the market didn't move fast enough will drain your account. So how do you decide? It starts with analyzing the market environment, not just the chart pattern. Is the market fearful, high IV, or complacent, low IV? Let's run a quick scenario test. If you expect a massive, violent breakout, the debit spread wins because its profit potential isn't capped as strictly as the credit received. But if you expect a slow grind up, or just not going down, the credit spread is superior. It extracts value from the passage of time while you wait for the trend. Here is the comprehensive decision matrix. This is the snapshot you should save. It combines direction, volatility, and time horizon into a single choice. Remember, liquidity matters for both. Ensure the bid-ask spread is tight, narrow. Giving up 10 cents of slippage on a $1 spread is an instant 10% loss. Finally, match the strategy to your account size. Credit spreads require margin collateral. Debit spreads require cash. Don't over-leverage a credit spread just because the probability looks high. To summarize, use credit spreads when IV is high and you want the odds in your favor. Use debit spreads when IV is low and you expect a sharp directional move. Check IV rank first, pick your strategy second, and trade safe.